Welcome back to Tokenization 101. I'm Kora. In our last episode, we compared tokenization to private equity, looking at how traditional finance contrasts with blockchain-based models of ownership and funding. Today, we're zooming in on another pillar of traditional investment, venture capital, often called VC. VC has powered some of the biggest companies of the last 2 decades. From tech giants like Google and Facebook to newer unicorns in fintech, health tech, and mobility, venture capital has long been the rocket fuel of startups. But how does tokenization compare to venture capital? Where does it overlap? Where does it diverge? And more importantly, can tokenization offer a better, fairer model for innovation? Let's explore. Venture capital is a specific type of private investment focused on early-stage or high-growth companies. It typically works like this. A startup pitches a VC firm to raise capital in exchange for equity. The VC invests money and gets shares, usually with special rights. In return, the startup gains funding, mentorship, and connections. The VC expects a major return, often 10x or more, when the startup exits via acquisition or IPO. Sounds simple. But here's the reality. Most VC money goes to companies already in major tech hubs. Founders often give up significant control early. The process is gated. Only a few startups ever get in front of VCs, and VCs themselves are managing someone else's money, typically limited partners, LPs, with a 7 to 10-year timeline. The result? A narrow funnel of capital that tends to reward a specific kind of founder, building a specific kind of company, in a specific kind of place. Now imagine a world where founders could raise capital from a much wider pool, without giving up control, without being bound to a single exit path, and without the geographic bias. That's the promise of tokenization. Instead of raising a $5 million VC round, a startup could tokenize part of its revenue rights, platform utility, or product access, and offer those tokens to a global community. These tokens could represent rights to future use of the product, offer access to early features or discounted pricing, include governance input, giving users a say in roadmap decisions, align incentives between users and creators, and crucially, tokens can be programmable. They can include vesting schedules, transfer restrictions, and smart contract logic that ensures responsible distribution and alignment over time. For startups that don't want to chase Silicon Valley gatekeepers, tokenization can be a way to build, grow, and fund themselves, while staying true to their community. Let's break down some of the key differences between VC and tokenization across practical categories. Access AMP. Participation VC. Closed process, selective backing, warm introductions required. Tokenization. Broader access, open to global supporters, within regulations. Founder control VC. Founders often give up board seats or decision-making power. Tokenization. Founders can retain control while allowing user participation through on-chain governance. Incentive alignment VC. Investors often focus on maximizing exit returns, which may clash with long-term product goals. Tokenization. Investors, token holders, often benefit from the platform's actual usage and growth, not just a buyout. Speed AMP. Flexibility VC. Multi-month process with heavy due diligence. Tokenization. Faster to deploy once compliant systems are in place. Exit strategy VC. Usually one of 2 outcomes, IPO or acquisition. Tokenization, flexible, tokens can be redeemed, used, or traded, if legal. Liquidity VC, equity is illiquid until exit. Tokenization, tokens may be tradable sooner, offering earlier access to value. Let's say you're building a logistics platform in Kenya, using motorcycles and real-time routing to improve rural deliveries. You need $1.5 million to build the platform, onboard drivers, and scale operations. Option A, venture capital. You fly to San Francisco. You pitch 20 VCs, 1 bites, they offer the money, but want 25% of your company, a board seat, and veto power over future fundraising. They're not convinced about Kenya's infrastructure, so they push you toward expanding to South Africa instead. Option B, tokenization. You issue a digital token that grants usage credits on your platform, priority dispatch rights for fleet owners, and governance input into your roadmap. You raise $1.5 million from early users and partners across Africa and the diaspora. you retain full control. Your community has a stake, and your growth aligns with actual usage, not just a future exit. That's not theoretical. Models like this are already emerging across mobility, clean energy, and even education. Of course, tokenization isn't magic. Startups must still comply with securities laws if their token carries financial return rights, ensure custody of tokens is secure and transparent, prevent market manipulation or pump-and-dump schemes, educate their community about risk and purpose. Smart contracts need rigorous auditing. Token distribution must avoid concentration in a few hands, and liquidity must be managed responsibly. But when done right, with legal counsel and infrastructure, tokenization can unlock new paths to innovation. Interestingly, some forward-thinking VC firms are now backing tokenized projects. They invest in both equity and tokens, seeing the benefit of aligning economic, social, and product incentives. Others are even launching tokenized funds, giving LPs programmable rights to returns. We're seeing the early days of convergence. In the future, it's likely we'll see more hybrid models, where equity and tokens work together. Equity brings structure, legal foundation, and long-term security tokens bring flexibility, community involvement, and market access. This is not a zero-sum game. So where do we land? Venture capital has been, and will continue to be, a powerful force for innovation. But it has limitations. It's slow, it's exclusive, and it can distort incentives. Tokenization offers an alternative, one that's faster, more inclusive, and deeply aligned with the way the internet operates. Open, global, and programmable. Both models have a role, but for the next generation of builders, especially outside traditional tech hubs, tokenization might just be the model that levels the playing field. In our next episode, we'll compare tokenization to IPOs, the public market's traditional gateway, and explore how blockchain could reshape public fundraising. I'm Kora, and this is Tokenization 101. See you in episode 7.